You're listening to The Millennials' Choice Show, Canada's most trusted podcast on all things real estate, finance, and entrepreneurship. Here's your host, Matthew Ablacan.
What's going on, everybody? Welcome to another episode of The Millennials' Choice Show, where we talk about all things real estate, finance, and entrepreneurship. Happy New Year. We want to get into a few different topics, guys. 2024 could be the best year of your life, financially speaking. It could be the worst year of your life, financially speaking. What do you think, Dan?
Man, I'm pumped about this year. Can't wait to see what's going to happen with the housing market. We're going to talk about that right now in this episode. Anything can happen, honestly. Some people are calling it the chaotic year. Some people are calling it, the successful year. We'll see what happens, but let's get right into it.
What we know for sure is that in any crisis, there is opportunity, and the rich get richer, the poor get poorer. It's the way it's been. You may not like it. Nobody cares. It's just the way it is. All right. So rather than being maneuvered in so many different directions, learn, educate, take advantage of opportunities. They're at your fingertips. Before we do that, share this episode with your friends and family, like and subscribe, guys. We have a big goal this year for both of our podcasts, and we want you to be a part of that journey. Thanks for listening. So today, Financial Post is reporting that the housing market has turned a corner, Royal LePage says. We're going to look at what the CEO of Royal LePage, Phil Soper, said about that. And then CTV News is reporting that economists see turning point in housing market this year as interest rate cuts loom. And then TD Bank has made a really bold prediction about interest rates and where they're going to be at over the next 12 to 18 months. And it's a massive prediction. It's a positive one. So we're going to get right into that. Danny, let's jump into the Financial Post article where the headline states, housing market has turned a corner, Royal LePage says. And Phil Soper discusses, he's the CEO of Royal LePage, what's in store for the Canadian real estate market when rate cuts begin. So if I just read a little bit of an excerpt here, he believes that the rates are going to go down and all the buyers basically that are on the sidelines, because we have a demand and supply issue. Let me take you back to February of 2022. That was just before the Bank of Canada began raising rates. They started raising them, I believe, in March or April of 2022, and things started to slowly slow down. February of 2022, however, I mean, you were working with buyers. I was working with buyers. We had listings for every house.
That was a fun time for
you. Yeah, not really. Like a lot of people think like for realtors, when the market's hot, oh my gosh, you must be making money. It's so easy. No,
it was the worst time.
It's the worst time for everyone. I think even sellers. Here's the thing about sellers. You might think that if you're a seller, like that's amazing for you when a market is really hot. And in ways it is. However, in ways it's not. And what I mean by that is when you get emotionally driven buyers driving the price of a property up way above what another comparable property in the neighborhood has sold for, you always run the risk of that buyer not being able to close that deal. So there is a lot of risk for the seller when this market just explodes. And so back in February of 2022, before interest rates started to slowly creep up, there were about like 20, 30, 40 offers on any property and so many showings. Showings was just on another level. So that was when rates were ultra low. Then they started creeping up. Now the CEO of Royal LePage is predicting that once the rates start to decrease, there's going to be this massive flood of buyers into the market and it's going to drive the prices up. It's important to note, you guys that are listening to this, that either own investments or want to jump into the market. Over the long run, we know what happens with real estate. Prices go up, rents go up. If you're renting it and holding it, your tenants are paying down your mortgage, building equity into this property. And in Canada, why were there 20, 30 offers per property? Why was this taking place? Not just because of low interest rates, but because we have a fundamental issue with our housing market, and that is supply. Danny, what are your thoughts?
Now, there might be some people like listening to this. I just want to point out that might be like, well, obviously these guys, they're real estate agents. They're going to be talking about how, the market's going to be hot and, you should buy now and now's the best time to buy. But realistically speaking, going back to what Matthew's talking about, guys, it's just a cycle. The demand is always going to be high here in Ontario. The supply is always going to be low. It's never going to be able to catch up to the demand. And the CEO of ROYAL LEPAGE, Phil, was talking about how they track this stuff, guys. They don't just kind of make it up on the spot. They track stuff. It's all data, right? And they interpret the data. So he was even talking about, in this article, they were talking about how in the month of December, sales went up by 8% month over month from November. November was a little bit slower and it picked up a little bit in December. So that's just a little indicator showing you there are people buying. There are people that want to get into the market, especially when the rates start to come down, which he was saying he believes will come down in the spring, I believe he was saying, or the summer. Yeah. A lot of economists are projecting for that to happen, especially this year. So I definitely think that's a possibility. It's not just a couple of real estate agents or realtors saying, oh yeah, the market's going to go through the roof. You have to buy something now just to kind of, get real people in. We don't need to do that, guys. People need housing at the end of the day, and we're the ones that help them find it.
Yeah, listen, I've been at this for 12 years, but I would love for you guys to become our clients. A lot of people listening to this podcast have become our clients and they enjoy working with us and I enjoy working with them. But I want to be very clear here. We are educating you guys. We are providing real data, real information, and boots on the ground. The market's not dead. I've been extremely busy. We've been extremely busy. It's given us an opportunity to focus on other things and do more marketing, create more content. But at this given time, for example, I personally have 9 listings. That doesn't even include my buyers, Danny's clients, mortgages, everything that we're doing. So the market is still active. What you have to keep in mind when Danny's telling you, that's a great point that you brought up about November and December. December, traditionally speaking, is one of the slowest months in the real estate market because think about it. You have the holidays, you have work parties, you have year end, you have so many things that are pulling at people's attention that traditionally speaking, it is one of the slowest times. I don't know why. I've said this to you before. December has always been the busiest month for me. In addition to all the holidays and things like that, it's just always been the busiest months. I did my first ever deal in real estate. It was like the first or second week of December, I think December 7th or 8th, that I did that deal in December. And ever since then, 12 years later, I've always had a busy December. But a lot of people thought about it. See, this is a tip that you guys can use. If December is the slower months, one of the slower months, then this creates an opportunity for me to then go into the market, find something I want to buy, and pick it up with less competition. Because a lot of people are going to be busy. They're not going to be looking. And so not only did 8% year month over month, the sales increase, but 21% of the total supply was absorbed in December. That's a lot of listings that were absorbed. So supply went down, actually went down a little bit more. The percentages work differently, but 21% of the overall supply. So if there are 100 listings on the market, 21 of those listings gone in December. That's a big deal.
Well, Phil talks about that as well too in regards to the rates. And people buy houses when they can afford them monthly, right? Because that's obviously how they pretty much determine if they can afford it. What do I make in a month? What's it going to cost me a month? How much will I have left over for food and all these things? So when the rates come down, people are going to be able to carry more property or bigger properties and whatnot. So they're going to be getting into the market as opposed to sitting on the side right now, or they'll be upsizing if they're already in the market. And what that's going to do is it's going to actually lower the supply, right? The remaining availability of housing, it's going to decrease. And as a result, demand's going to be going through the roof once the rates come down. What's that going to do? Guys, prices are going to go up. Let's be real. I'm not trying to, report doom and gloom for those people that are trying to get into the market and still find it difficult now because of the qualifying rate and these things. But guys, it's only going to get harder when the prices go through the roof and you have 30, 40 offers on one house. It's just the reality of Ontario, unfortunately. It's not a great thing. I don't like that. Like Matthew was saying before, it's not really a good thing for anybody. There's a lot of pros and cons, but it's going to happen. And even the CEO of ROYAL LEPAGE was talking about when the rates come down, guys, the market's going to go through the roof. And it's just a matter of time, once the Bank of Canada makes their announcement. He does think, though, that sales or the prices will actually reach the bottom Q1 of this year. and then will actually rise around Q2, Q3 once the rates get cut from the Bank of Canada, which I also see definitely can happen. Very strong possibility.
You just made a very good point. Finally, in a long time, you made a good point. But basically, what I heard you say is you are dating the rate and you marry the house. And what that means is in a scenario where, let's say, the property value has dropped for a particular property from, let's say, 1.5 million to 1.2 million, just as an example, and you're getting a little bit of a higher rate today. Yes, the monthly payment will be higher than it would have been if you purchased the property at 1.5 million at a lower rate, but you can always refinance your mortgage. Let's say the rates come down 2 years from now, and now your monthly payment is going to be even less than it would have been because you purchased the property for much less than what you could have when the rates were super low. So you still got in, you might have had to swallow a little bit of a higher rate, but when the rates come down, you could refinance, lock in a lower rate, a lower monthly payment, but now you've purchased something that was cheaper than it once was at the height of the market. And so that's what I'm hearing you say. That's what Phil mentioned as well. And I like that because that's where the opportunity is right now. When people are waiting for this massive correction to happen, you don't know if that's going to happen. You don't know for sure. You don't know if that's going to happen. But what we do know for sure is that supply is still low. Nothing's changed over 2 years. In fact, we've had more immigration, which we talk about on another episode. We've had less housing starts, new housing starts, meaning new builders that came to the market, launched a product, sold it, and then, started constructing it. We've had less of that. It's actually been a record low in Canadian history. And that means that in the long term, you are going to have a lot more demand and supply issues, especially if we're bringing more and more people to the country.
And Phil talks about that though. Here in Ontario, guys, anybody listening to this, our supply will never catch up to our demand. It's not going to happen. It is not going to happen. There's just way too much demand for housing. And like Matthew said, that we talked about in another episode, there are a lot of people coming into Ontario right now. And those people need a place to live. Plain and simple. Like, don't think too much about it. It's just, does everyone need shelter? Yes. Okay. So there's a demand. Can we keep up with that demand in creating houses? No, we can't, for a lot of various other reasons. And as a result, pricing for houses increases, not just for purchasing property, but also renting property, which we've all seen in the past few years has skyrocketed through the roof. And it is going to be a problem for a lot of people even looking to rent that are going to have to co-rent, with other families or other people just so that they can afford it, right? But it is happening right now and everyone's talking about it. So if you have any questions, obviously, about this, reach out to us. We're always here to help. And it's just going to keep going up and up.
I want to turn to the CTV News article that the headline reads, "Economists see turning point in housing market this year as interest rate cuts loom." And the reason why I want to turn to that and why I'm bringing in the Economist is because the fact of the matter is Phil is not a realtor. He's a CEO of a real estate company. So I don't want you guys to think that this is biased. We're bringing you some sort of realtor's comments on this. Let's look at what the economists say who study the economy. That's their job. And they may not have a direct, interest in real estate. They're just presenting stats, numbers, figures, expectations, and predictions. And let me read a little excerpt from this article. So after a year marked by caution and shifting expectations spurred by rising borrowing costs, economists believe the Canadian housing market could be in for a rebound in 2024. That's largely dependent on forecasts that the Bank of Canada could begin cutting its key interest rate from the current level of 5% as nearly as the second quarter of this year. So exactly what Phil and others are saying, including TD Bank, which we'll look at. This is a quote from TD Bank economist Rishi Sandhi. "We're obviously watching for a turning point in the market. We've had some, I would say, weaker sales and price activity over the past few months. We're getting some indications that the market, at least from a demand perspective, is starting to turn around." And really quickly, I just want to jump in here. Nothing's changed. The rates are at the highest they've ever been. So the fact that economists third-party economists are saying we are seeing indicators in the demand area that's causing the market to turn around. Well, what's changed? The rates are at the highest they've ever been. So at the end of the day, you are looking at a market where demand is ultimately the driving force. Danny, what are your thoughts?
It could also be that the 5-year fixed rates have come down slowly, right? That may play a factor. People are starting to feel like there's, a lot more potential to get into the market right now before rates decrease even further, right? So there's those signs of rates coming down, and as a result, they're not going to be able to get into the market later once the market really goes through the roof and improves and prices increase, like we were talking about before. Even the RBC assistant chief economist anticipates, sluggish housing activity at the start of 2024, but foresees a gradual increase in home prices later on in the year. So this isn't just real estate people telling you about it. It is the economists saying prices are going to go up, not may go up. They are going to go up once the Bank of Canada cuts rates. And, what are we waiting for the Bank of Canada? We did another episode about it, but for those of you guys that haven't watched that one yet, we're going to talk about it a lot more in that episode. But going back, if they decrease the rate, the Bank of Canada decreases the rates, like we said, a lot more people are going to be able to afford it monthly to purchase a home if they're going with the variable rates. And, fixed rates have come down, like I just said, and that's going to cause a huge spike in demand, more than there is even right now, like Matthew was just saying. So guys, again, what's going to happen? Supply and demand. Demand's going to go up. Supply is remaining the same. Prices are going to go through the roof. Everyone's saying it. Even economists are saying it right now.
So I'm also not opposed to the argument that the rates are going to stay higher for longer and that rates could essentially go up. We don't know that because it's all about that inflation target. And, guys, we're not a conspiracy theory channel. We don't divulge in things that are not verified. We want to give you factual information here. So we're not going to go down that rabbit hole in terms of how the inflation percentage is calculated and things like that. But really, when you're seeing the number they're giving you go up from 3.1 to 3.4, 3.3 to 3.4, when you're seeing that go up, that means they're not hitting their target of 2. And they've said they need to hit their target at 2. So let's not just be overly optimistic that rates will come down. These are people's predictions. And also, it's been almost 2 years since rates started to go up. That's a long time. So chances are, as you start to see the central bank, which is a privately owned entity, by the way, the Bank of Canada is not owned by Canada. Hope you guys know that. It's a privately owned entity. When you start to see them saying, okay, you know what, now we're pausing the rate increases, then chances are after 2 years of raising them, year and a half of raising them, now we've reached 2 years, and then they started pausing them, chances are they'll go the other way, which is down. Chances are. That doesn't mean it's going to happen, but that's the likely outcome that most people are calling for. So just keep that in mind. There could be the other scenario where rates stay a little bit longer, a little bit higher for longer, or they start to come down, but not nearly as quick as people would like for them to come down.
For sure. And even we talked about affordability and carrying costs monthly, but we also need to focus on when the rates come down, it's going to be easier to qualify for a mortgage because of the stress test. For those of you that don't know, people right now are currently qualifying at a rate 2% higher than what their actual contract rate is. So right now, if people are getting a rate of 6%, they're having to qualify at 8%. So what that means for you, someone listening to this that wants to buy and get into the market, if the rates come down to 4%, you're only going to be having to qualify at 6%.
Yes.
Right? In that situation, unless the rules change and whatnot. That's going to mean that you're able to get a higher mortgage amount, which means you could buy maybe a home or something that you are very happy with, and you don't have to settle for, let's say, a condo necessarily, whatever the case is, right?
It gives you more purchasing
power, flexibility, and those kind of things, and gives you more options, which enables more people to get into the market, further driving up the demand.
So that's the other thing that people are not keeping in mind right now. A lot of buyers are sidelined, not simply because they want to wait and see what happens. They are sidelined because they are not able to qualify for the mortgage they once were, because as borrowing costs continue to rise and it's harder to qualify because, as you said, we have a qualifying rate scenario here in Ontario, at least, where now they have to qualify at 2% above what they're getting. So if you're being offered 6.5% with the bank, you're qualifying at 8.5%. That really diminishes your purchasing power. So some buyers are just sidelined just for that reason alone. Yeah. Whereas there's some buyers that are sidelined because they want to wait and see. But if you guys, the ones that are waiting and seeing what happens, okay, you've waited for 2 years now. This is your time now. While these buyers are sidelined, they can't buy. You can buy. Go make deals. There's deals out there. There's how many did I show you on my Instagram the other day? Power of sale listings. You guys are waiting for all these mortgages to come up for renewal. I just sent 49 power of sale listings to somebody who asked me for them. They're already there.
They're there.
They're there. It's happening, but you're waiting to see. And the problem is you're getting your information from places that don't want you to be successful. Mainstream media does not want you to crack the code and become super wealthy. They don't want that for you. It doesn't work that way. The government does not want you to do that because they know the super wealthy pay very little in tax. It's the working class that pays the most in tax. Think about it. It's just money. Yeah. It's principles of money. So when you guys are saying, I'm waiting and seeing what's happening, there are lenders out there right now offloading properties because the market changed, because there was a decline in prices year over year in certain property types and certain markets. It's up to you now to come to the table and make a deal happen. You may not want to do a deal because of the high interest rates. But remember, that's only temporary. I'm looking at, that's power of sale, that's resale, properties already built. I'm looking at people with pre-construction that bought in 2020, 2021, 2022, and 2020, mostly 2022. They want to offload some of their properties, especially townhomes I'm seeing, and some single family, where they just want to get rid of it for what they paid for it. Why? Because they just don't want to close. They speculated. They don't want to close. They don't want to pay the high rate. Some people can no longer afford for the mortgage. They afford qualifying for the mortgage. They were borderline. And as we just said, the qualifying rate has gone up, so they don't qualify anymore. And they don't want to go private or whatever the case may be. These are opportunities for you. If you could get something at a 2021 price, 2022 price, now 2 years later, you're getting it for that price, you're winning. You're winning. You just have to buy and hold. Everyone likes to hold their crypto, which hasn't been performed. Everyone jumped on that bandwagon once the millionaires and billionaires made their money. You jump on this bandwagon and it's losing, but yet you're so passionate about it's going to bounce back. It's going to bounce back. Yeah, everything bounces back, like typically. That's what happens, even real estate.
Exactly. But you know what?
But real estate has utility.
Yeah, but you know what really pisses me off though? Like I can't stand the people. And like if you're listening to this and you're one of these people, like I'm not trying to come at you personally, but it bothers me when people buy real estate, especially really expensive real estate, only to like for the hope of it's going to go up in the next couple of years or next year or so from the time you bought it. There is a really, really strong chance that's not going to happen. And if you're banking all of your money, sinking all this money into this property, whether it's pre-construction or resale, hoping on the hope that the rates will come down. And as a result, the market will go back up. And that way you'll be able to make some money on it or close or be able to refinance. You should not buy a property, risking all that money, risking everything for a very short-term turnaround. Guys, there's a lot of people that did that and they lost their money. They lost their house. I saw somebody, I don't know how I saw it, but it came up. They spent $1.5 million on a cottage. And it was it's a power of sale right now from a private lender. And it seems like they bought this cottage for 1.5 and they ended up selling it, I think, for like 1 mil. These guys overpaid by $500,000. Like, just really understand that and take in like where was their state of mind at when this was happening? Again, if you're one of those people, like you're really, just saying, oh, I want to put $100,000, I want to put $200,000, in a property, and in a year or two it's going to go up because the rates are going to come down. Please stop what you're doing and don't do that. You're better off just throwing that money in the fire and just burning it, as opposed to going through all that mental anguish and trauma of, having to get dragged out of a house if you're getting kicked out or it's getting foreclosed on you. Why would you put yourself and your family through that potentially? you should not buy real estate unless you're able to hold it, like Matthew just said. And that's my whole little spiel.
It's a business like no other. So if you're investing in a business like a restaurant, for example, and you don't know what you're doing and you're hoping there's no plan and you're hoping for the best, don't expect that restaurant to do well and succeed. There's plans that have to be put forth, right? Even when you get financing for a restaurant, let's say, there has to be a business plan, right? So the lenders require that. You need to have your own plan in life. If a basketball team has a plan to win the championship, you need to have a plan for your life. Real estate's no different. It's not easy to buy. It's easy to buy. It's not easy to close a property. It's not easy to go through all the things that come with that, especially in markets where there's a lot of volatility or uncertainty. We're seeing it firsthand with builders, lenders, buyers, and sellers, where there's hurdles that we have to go through on behalf of our clients, even on behalf of ourselves for properties that we're closing that weren't there before. So it's not easy. And if you don't, we do this full time. If you don't do this full time, this isn't your job, career, or you're not buying properties full time, you have a day job, it's going to be such a burden for you. It's going to be very unpleasant, very emotional. It might actually turn you off from doing it again the next time. Yep. You need to be in a position where even if the market takes a turn for the worst, you could weather the storm. Okay? You could weather the storm because that's the situation we're in right now. The difference in rates from 2 to 4%, you might think it's only 2. It's not. It's a big difference because interest is compounded a certain way with mortgages. We're doing a mortgage, let's say for a property I bought in 2017. It's closing now, 7 years later. Lots of equity in the deal. Bought it for $440 with upgrades. It's selling right now for $700. Lots of equity in the deal. But when I close it with today's rates, I'm going to basically put a couple $100 out of pocket every single month today, 7 years later. Why? Because the rates make a big difference. So when you're doing the numbers, if you go down from today's rates, let's say I was basing it off of 7%. Let's say I go down to 4%, which is what I was basing it off of. I literally pocket $400 a month after that. So it's a big difference going from 4 to 7 or 2 to 4. And in this case, 2 to 7 in a lot of cases. So that's a big difference. My point being is don't just jump in thinking that all you can afford is the monthly payment now. You need to be able to afford that and then some because you don't know what's going to happen.
And a lot some, dude. Even for these people that dropped like $1.5, $2 million on these huge, massive single detached homes, when the rates were 2% or 1% for a variable rate, guys, now when you're coming up for renewal, what are you going to do? Your payment has almost like literally doubled or tripled and people are having to walk away. So there are going to be good opportunities if the rates stay the same until, mid 2024. You never know. Some people might be renewing early Q1 2024. And they might not be able to hold on to it for 5 or 6 months. They're gonna have to sell it. You don't know what terms they got. Some people got 5-year terms when the rates were super low. I did 5-year fixed. Everyone said I was nuts. I should have done the variable. I should have done 3 years. I did 5-year fixed. So a lot of my stuff is good for another couple of years, which I'm very happy about. I'm happy about my 2.65% rate, guys. You don't get greedy. Don't get greedy in this business. That's the key thing here. Conservative. Everything I've done, conservative. Now a lot of people, easy for you to say you have all this. Buddy, we don't have parents that come from money. We don't have parents in this business. We don't have parents that bought investments. We don't have parents that gifted us down payments and stuff like that. They gave us a good living, like a good upbringing, taught us how to work and how to, put in the work and not complain. They're immigrants. And we decided to go this route. So it took a lot of time, and I'm not financially free, but it took a lot of time to get to this point. But my point being is I took conservative steps, conservative risks, because I didn't want to lose my shirt, as they say. But before we close off, I really want to jump into that TD Bank article. This is TD Bank, you guys, Toronto Dominion Bank. They are one of the largest banks in Canada, and this is what they had to say about when will interest rates go down in Canada. So TD economists forecast that the Bank of Canada will begin cutting rates starting in the second quarter of 2024. We think the Bank of Canada will remain on hold through the end of this year, 2023, and the first quarter of next year, 2024, before initiating a series of rate cuts starting in the second quarter of 2024. Now,
They go on to say that there are a few factors contributing to TD Economics' prediction, including inflation moving more convincingly towards the Bank of Canada's 2% target, the labor market beginning to show signs of moderation, and several quarters of subpar economic growth. The Bank of Canada are trying to achieve this soft landing scenario, and this is the economist who said this, and they want to have core inflation moving towards 2% without breaking the back of the economy or leading to a sudden or steep recession. Just going to the labor market beginning to show signs of moderation part, you have to understand when the Bank of Canada is raising rates, one of the things they want to achieve is they actually want to achieve a higher unemployment rate. They want more people to be unemployed to slowly slow down the economy. They factor high employment with more people spending money and consumer spending because they're working.
Makes sense.
Right? So sometimes when you see a lot of, this company laid off this much staff, a lot of it's designed to achieve this higher unemployment rate number. So there's a lot of factors that play a role in this, but TD is being very, very bullish, stating that, so basically the Bank of Canada rate right now is 5%. They believe it'll be cut in half, which is kind of where we were at in 2020 and 2021 and somewhat at the beginning of 2022 by the end of 2025. They think that that's going to happen.
I could see that happening, though. End of 2025 is a long time from now. So we're in the beginning of 2024 right now. It's a couple of years, right? It's definitely possible. That's for sure. And like you said, they increased the rates, right, to reduce spending because there's too much people spending after what happened with COVID, right? Everyone was locked up for 2 years. And then after that, people had to go and wanted to go out and spend and whatnot. And as a result, inflation went up through the roof, right? Supply chain issues, all that played a role in causing the inflation to go through the roof, right? Prices of groceries, everything went up, gas, everything went up. And the Bank of Canada, increased the rates so that they can kind of stop the economy from getting out of control, getting out of hand. And right now, like you just said, they're trying to lower the rates in a certain way so that, it is a soft landing and, people don't, too much people don't lose their jobs. And at the same time, there's still some sort of kind of weird balance between affordability in housing and unaffordability for those people that shouldn't be buying real estate, kind of like what was happening in 2022 when there's 30, 40 offers on a property for people that couldn't really afford it, right? Which makes sense.
Listen, at the end of the day, there's activity in the market. There are people buying, there are people selling, and we know it. A lot of realtors we know are also going through it. There's a lot of people twiddling their thumbs, a lot of realtors and mortgage brokers that are twiddling their thumbs. Please do not work with those people. You do not want thumb twiddlers on your side. You want proactive realtors and agents that know what they're doing. And I know the market is busy. But with that being said, it is a weird time in the market. So do your research, do your due diligence, reach out to people that are like us, that are experts in their field, that are investing, that are growing their portfolios, that are buying homes for their families. That's who you want to learn from. Okay? Learn from people who are achieving what you've already, who are already achieved what you want to achieve. Okay? Learn from those people. Don't learn from people that haven't done what you want to do because they won't have anything to teach you.
There's no experience there, right? And there's so many people that, when they ask me, how's work and stuff, I'm like, they're so shocked when I tell them, I'm actually so busy right now. It's funny because
all the time.
It's always like everybody's like, oh yeah? That look, it's like, oh yeah, you're busy.
They don't believe you.
That's the thing. They don't believe you. And I know that.
And you know what? I don't need you to believe me. It's, keep doing what you're doing. I'll keep doing what I'm doing.
Exactly.
Time will tell.
But I don't think it's like a personal thing. I think it's just they're surprised because I think when they ask other people maybe in the industry and those people tell them, oh yeah, it's dead. It's dead out here. There's nothing going on here. I'm not busy at all. They hear that from so many people. And then when they talk to someone like us, like in my example, I'm like, yeah, I'm actually so busy. Like I'm very, very busy with work.
I haven't stopped
helping
guys.
Clients. Like
I literally, Sarah's pregnant. We're about to deliver the second baby. Keep us in prayer. I literally can't wait to go to a resort. I want to be on a beach, guys. I want to be on a beach so bad, just relaxing under the sun. Last summer was a rainy summer and we just had James. We didn't really get to enjoy, but you don't understand how busy we've been. And for the realtors and agents listening to this, guys, create more content, update your marketing, become more valuable, take some new courses, reach out to all your clients in the past, do certain things to build your business now that you have the time to do it. Rather than being reactive to what's going on, be proactive. That's what we do. If our volumes dropped, which it has, like everyone, that's what happens. At the end of the day, we don't just stop what we're doing. We now look at what can we do that we couldn't do before, that we put on the back burner. And that's what we've been doing. So we have way more output. We actually have a lot more listings now. We have a lot of stuff closing. We're working. We're proactive. We're busy. Stop bothering me after 9 p.m. if you're my clients listening to this. I have a life as well. And guys, check out some of our other episodes where we really talk about what's going on with the Bank of Canada, what's going on with their interest rates, what's going on with immigration, buying pre-construction real estate, buying multifamily. We have a whole array of content for free for you guys. And we have a big goal of reaching 100,000 downloads for our real estate and finance podcast. Share this with your family and friends. Any last words, Danny?
I was just going to say, if you took anything away, anything of value away from this conversation, like make sure to share it with a family or friend that you know needs to hear this, because it's only going to help them and, catapult them further and push them in the right direction. So make sure to, share, smash that like button, drop a comment. We do read the comments ourselves personally. There's no, random stranger that reads it in comments. It's actually us. So we'd love to see all the comments. Again, reach out to us. Instagram handles Danny Ablacan, Matthew Ablacan, Millennials Choice on Instagram. Make sure to DM us. We use our own Instagrams, so we will see the messages ourselves and respond to them as well. So looking forward to hearing from you guys. And until next time, guys, we're out.